Today, folks, we're going to talk about TD right now that is pleading guilty to their money laundering fine. They're going to face $3 billion in penalties. They're going to be asset capped in the United States, meaning they can no longer grow their business. The stock is trading down 4% today on that news. The dividend yielded at around 5%. We got to talk about what this means for us as shareholders and talk about the future of TD. Is this a value play? Is this something we should be picking up on the back of one of the worst fines in financial history? If this is a conversation you appreciate as a dividend lover, a passive income generator on your path to financial independence, subscribe, join me on that journey, and consider hitting that like button and letting me know what you think in the comment section, because TD will be hosting a conference today. They have not told us what time that conference call is going to be at. They did issue a news release, but here we are just sitting on our hands to find out from the horse's mouth exactly how they feel about what they're facing and what the path forward truly looks like. And we're going to break that path forward. We're going to take a look at their balance sheet, so many other details, but I want to break down a few clips from this morning on BNN where they offered some pretty intriguing insights. So let's just take a listen.
Hello, you're watching The Open on BNN Bloomberg. We're tracking shares of TD under pressure in the pre-market. The Journal and others reporting that TD is going to be hit with a $3 billion fine. Now, that's maybe not such a huge issue because they did provision as much as $4 billion. But the second part is perhaps what's a little bit more troubling, is that they're going to cap asset growth, which means that TD, which has relied on growth through acquisition and growth through its U.S. retail bank, could be hampered in that way. Worth noting that TD is expected to hold a call today. They put out a media advisory at 6:30 a.m. Eastern time suggesting that they will host a call, but no details on timing. Certainly, investors will have a lot of questions about what this means for the path of growth going forward. Let's bring in one of those investors, Brian Madden, Chief Investment Officer
let's
at
listen
First
to him, but
Avenue
skip to a more
Investment
meat and
Council,
potato part
joining
of the
me now.
video.
Brian, thanks so much for joining me. First, Raymond Chun, he takes over in the spring of next year. What do you want to hear in terms of a concrete plan or steps to address this?
Well, first of all, we need to hear, from TD themselves, the actual details of the settlement, because obviously what we're talking about now is just a story that another media outlet has broken. It's probably quite accurate given the source, but we need to get the concrete details from TD and the regulators as to the size of the monetary penalty and the particulars around the asset cap. Certainly in the case of Wells Fargo, we know it was basically imposed at that time current size of their balance sheet, which was $1.95 trillion. So what we're going to want to hear from TD when their conference call is held later today is that they are doing everything humanly possible to make the bank squeaky, squeaky, squeaky clean so that this asset cap can be lifted as soon as possible. We know for Wells Fargo, it's been in place since 2018. So that's 6 very long years, during which time they've been unable to grow their balance sheet. The other thing we'll want to hear, and by the way, I should mention, TD is already well down that path. They have signaled for the last year that they're earmarking somewhere around $1 billion in increased operating costs to beef up their anti-money laundering and compliance capabilities in the United States. They've hired a lot of people to do that. We're also going to want to hear about ways that they're going to find to offset those increased investments in AML and compliance. So we have heard some details on that. Hopefully they'll double down and find some more efficiencies. And then we're going to need to hear about, what's the new strategy? This is a bank that generates quite a lot of internal capital every quarter. So
let me talk about a few things he mentioned here, and then again, I'm going to skip to a more intriguing part of this video. But what he did mention, and the most comparable in these fines, would have been what happened to Wells Fargo back in 2016, because they got asset capped after they were basically using their employees through promotions and basically, you bring in more clients, we'll give you better bonuses. So they were making fake customer accounts to achieve those bonuses, which basically forced Wells Fargo a massive fine, one of the biggest fines headlines in financial history at that time as well. And they asset capped the business from growing, which, by the way, that asset cap still has not been lifted. And I don't think it's going to get lifted until basically next year. And we can see that the stock did drop pretty dramatically, but it did recover. And then the pandemic hit, and it's still pushing toward all-time highs. Clearly not as great a performance as something that we've seen in the bigger banks, similar to Canada, right? Like JP Morgan is the bread and butter of the financial institutions in the States, like Royal Bank is here, and JP Morgan and Royal Bank have absolutely clobbered. But let's just skip a little bit farther ahead here, because there's a few other things I want to point out before we talk about the value of this bank and if it's a buying opportunity here. And again, what these asset caps might mean.
About an 11 or 12% discount. That's based on yesterday's close. Of course, we're seeing the stock. Right? Like, the stock is trading in terms of its price to earnings ratio at about an 11 or 12% discount. That's based on yesterday's close. Of course, we're seeing the stock quoted down 4 or 5% pre-open here. So, that discount is only going to widen further relative to the PE ratio of the big six banking peers. So to a degree, perhaps, a lighter trading multiple relative to its historic norm is warranted, given that U.S. growth avenue is going to be severely throttled for a period of time. It doesn't mean they can't grow their earnings at all in the United States. They're just going to have to find ways to grow their earnings without growing their balance sheet. That's not an easy proposition, but it's not impossible. It just means you need to sweat the assets better and, sort of create more returns on assets and more returns on equity with the existing size of your balance sheet. But yeah, we think we're still looking at a bank that has the second leading personal and commercial banking franchise in Canada. It's good and it's getting better. And TD has scale to be certainly the number 2 player there for the foreseeable future. And it's got a very good wealth and asset management and insurance business in Canada. It's got a subscale, but growing meaningfully with the acquisition of Cullen wholesale banking franchise. That's an opportunity to redeploy capital and perhaps consolidate that space. That's been a good business this year. So we think this is, the reputation of this bank, particularly in the United States, has been tarnished, but not irreparably. Remember, this is a bank, Amber, whose roots predate the Confederation of Canada.
Yeah, TD's been around for a long time, I think over 100 plus years or something crazy like that. But let's talk about TD Bank. Let's talk about the future of this and where we see the stock going. Because, yeah, I think it's important to sever off their businesses and talk about the size of their businesses, because unlike Wells Fargo, that primarily operated in the United States, Toronto Dominion's got a nice, diverse business that will feel some pain from this, but should largely be cushioned to some extent. If we actually just take a look at their Q3 2023 highlights, not only did they see 10% year-over-year revenue growth, which my bull case for the banks is they start actualizing the revenue without having to deal with as many provisions for credit losses, which went up dramatically because of the higher interest rate environment. But when we break down the severed part of their businesses, we can see the Canadian personal and commercial banking for Q3 did about $5 billion, which was up 9% year over year. If we actually take a look at the U.S. retail, so their operating momentum here on the retail U.S. side of things, actually only grew by 1% at $2.59 billion. So to put that in perspective, wealth management insurance also did pretty well at 13% year over year. But when it comes to U.S. Compared to Canada, Canada is still one of the largest market segments for this bank. And when we've seen the growth that we've seen out of things like Royal Bank and the fact that this bank specifically is still growing at an accelerated clip, like doing very well. I mean, take a look at the 9-month end here for the last earnings. They did 41.7 billion versus 37.5 billion. They're growing, right? But again, when we take a look at what they have to put aside to deal with this stuff, so provisions for credit losses were 3.1 billion, which was up $1 billion from last year. This is starting to peter off because we're seeing that in their now quarter-over-quarter results. But they also have to take this non-interest expense that was reported, where they put the extra 2 or 3 billion aside to deal with these fines, which is why it jumped from 8.4 to 11 billion. That really increased the 9-month ending non-interest expense. So when we take a look at their net income, it looks a bit trashy right now, right? 5.2 billion versus 7.7 billion. It's not like the greatest thing we want to see, but they are adjustable costs that are usually, one-time expenses, presuming the economy doesn't completely collapse, because that is the bear case on the Canadian banking sector, right? You have to presume real estate and the whole economy is going to crash if these banks are going to do terrible and have bank runs or things like that. But what comes down is, I'm curious to the exact asset allocation coming out of the United States, because their total assets sit at $1.9 trillion, which is, a hard number to spit out. I mean, it's a stupid amount of money under their management or assets in their bank, which is quite staggering. And if you kind of scroll down, and if you're a dividend oriented investor, that's why you're holding TD, I wouldn't focus on the yield payout ratio right now, because it's going to be all over the place because of these one-time expenses, the things going on that will not directly affect the dividend itself, because they can afford the dividend. Like most banks, their payout ratio is exceptionally low. But when you're putting away one-time expense fees of $3 or $4 billion, yes, your expense ratio might jump out a lot, but then in the coming quarters it's completely affordable, because they put all that money away on one quarterly expense. So it's important to keep in mind that when we compare the performance of its next closest bank, Royal Bank, and we look at the growth it's had in Canada and is still doing exceptionally well, this aspect of TD is going to continue to do well, and I think make up, hopefully, for some of the detriment that's going to go on in the United States. And that also doesn't mean they can't grow the margins of their United States assets either. And I want to keep that in mind. Just because they're going to put a cap on it for a limited amount of time while they deal with the fines and the penalties, and again, this can take years, doesn't mean they can't keep generating good cash flow and increase the margins on that cash flow off the assets they have. That's a possibility as well. But my bull case continues and remains to be that as provisions for credit losses can start to deteriorate, we'll see higher net income capability, and we'll continue to see a recovery at a TD stock that, again, is trading at a discount. That discount comes with a lot of the negative headlines. But like banks, I just recommend collecting them all. Buy VDY, buy ZEB or HBNK, or any of these like equal weight bank ETFs. They're great things to own. Again, they're ebb and flow, just like the US banks. You just want to own the big companies. Not like we don't have a lot of regional banks or smaller banks in Canada. It's kind of just a monopolistic business. They've just been around forever, but they're highly regulated. And because of that, they offer a lot more stability over longer periods of time, which we can see in their stock price. So I'd look at this as a buying opportunity. A lot of people in our chat group are buying it. I'm still cost averaging into VDY. I have full faith that the company will recover over the long term. And for now, it trades at a discount. But I'll pass that question off to you. I'd love to know what you think about TD in that comment section below.